Imagine you're a CFO and you've just borrowed $500 million. Yeah, $500 million. The only problem? Your interest rate is a ticking time bomb. It's floating, so it could shoot up at any moment. So today, we're going to demystify the exact tool you'd use to defuse that bomb, the interest rate swap. We're going to break down a real dealer quote and see exactly how it all works.
So here's our game plan. First, we'll dive into our CFO's huge problem. Then we'll talk about the financial tool that's going to save the day. After that, and this is the key part, we'll learn how to read a dealer's quote. We'll see the swap in action, clear up one super common point of confusion, and then we'll wrap it all up with the bottom line. Okay, let's get right into it. Section 1, the CFO's big problem. And when I say big, I mean a $500 million headache. So here's the deal. The company needs to raise $500 million for a big 10-year project. But there's a major catch. The only loan they can get their hands on has a floating interest rate. You know, this is a massive gamble. If rates spike any time over the next decade, their interest payments could just explode. It would throw their entire financial plan into chaos. So the goal here is crystal clear. They have got to find a way to lock in a stable, predictable, fixed interest rate. So how on earth do you do that? Well, that brings us to Section 2. The answer is a really clever financial tool called an interest rate swap. So what is this thing really? Let's get the textbook definition out of the way. It's an agreement where two people, or companies, agree to exchange cash flows. One of those flows is based on a fixed rate, the other on a variable one, and it's all calculated on a principal amount that, get this, never actually changes hands. It's just a reference number, what the industry calls a notional amount. Okay, I know that sounded a little dense, so let's make it way simpler. At the end of the day, it's really just a trade. Think of it like this. I agree to pay your floating rate payments if you agree to pay my fixed rate payments. That's it. We're just swapping obligations so we each end up with the type of payment we actually want.
All right, so the concept makes sense, right? But what does this look like in the real world? This is where it gets interesting. Let's move to Section 3 and decode the actual quote our CFO would get from a dealer.
So the CFO calls up a swap dealer for a 10-year quote, and this is what they see on their screen. Two numbers, a bid at 2.05% and an ask at 2.20%. Okay, so what do these mean and which one is the right one for our CFO?
Let's break this down. The bid rate is for someone who wants to receive fixed payments. But that's not our CFO, right? Our CFO is stuck with a floating rate and wants to get rid of it. They want to pay a fixed rate. So they look right over to the ask side. The deal for them is to pay the dealer a fixed rate of 2.20%. Simple as that. Now, that little gap between the two numbers, that 2.20% ask and the 2.05% bid, that's really important. That 0.15% difference is called the bid-ask spread. And that, my friends, is how the dealer makes their money. It's basically their fee for setting up this whole transaction. Okay, so this brings us to the best part, Section 4. We've got the problem, we've got the tool, and we've got the price. Let's put it all together and watch this swap actually solve the CFO's problem in real time. Here is where the magic happens. First, the CFO officially takes out their loan. The cost is a floating benchmark rate. Let's use LIBOR for this example, plus 1%. Next, they execute the swap. We already know they agree to pay the dealer that fixed ask rate of 2.2%. But in return, the dealer agrees to pay the CFO the floating LIBOR rate. You see where this is going? And boom, look at the results. The LIBOR payment coming in from the dealer perfectly cancels out the LIBOR payment going out to the lender. That whole volatile, risky floating rate part of the equation just vanishes. All that's left is their original 1% loan cost plus the 2.2% swap cost. Their total, effective, and most importantly, fixed rate is now 3.2%. Problem solved. We're almost done, I promise, but there is one final detail we absolutely need to nail down. This is a super common point of confusion that trips a lot of people up, and it's all about the word spread. So let's clear this up right now in Section 5. Okay, listen closely, because this is so important. The swap spread you might hear people talking about on the news is not the same thing as the bid-ask spread we just discussed. They are two completely different concepts that just happen to share a word. This table makes the difference totally clear. Let's start with the left column, the bid-ask spread. What is it? Just the difference between the dealer's buy and sell price. And its purpose? It's just the dealer's commission for doing the deal. Now, look at the column on the right, the swap spread. This is something else entirely. It's the difference between the swap's fixed rate and, say, a Treasury bond yield. Its purpose isn't transactional at all. It's a big picture market indicator that tells you about things like credit risk and liquidity in the whole system. All right, let's bring it all home in our final section, the bottom line. What are the key things you really need to remember from all this? So, what have we learned? Well, first, we've seen that swaps are these amazing tools for managing risk, for turning uncertainty into certainty. We learned how to read a dealer's quote. If you want to pay a fixed rate, you look at the ask. If you want to receive a fixed rate, you look at the bid. We also know that the gap between them, the bid-ask spread, is just the dealer's profit. And most importantly, we saw exactly how our CFO used this to transform a wild, unpredictable cost into a stable, fixed number that they can now budget for with total confidence. You know, we just took this super complex sounding piece of financial jargon and broke it down into a logical, understandable process. So the final thought I want to leave you with is this. Now that you can actually decode an interest rate swap, what other complex financial tools out there seem just a little less intimidating?